Good morning, everyone. I'm Linda Kristovic, and I'd like to welcome you to the 2023 annual meeting of the JKV Foundation. Today we are celebrating 31 years since the foundation was founded in 1992. The first year was devoted to creating and filing legal documents such as the organization's bylaws and articles of incorporation. During this period, the first brochure was created with help from the students at Stetson University. But in 1993, things really got underway. Margaret James became chairman, and under her leadership, the foundation's primary goal of providing a safety net for residents who had exhausted their resources became a reality. Last year, the foundation provided financial assistance in the amount of $131,000 for residents needing some form of financial assistance. Some of these residents needed help paying monthly service fees, or assisted living surcharges, or subsidizing the cost to have home health assist with dispensing medications for residents who otherwise are capable of remaining in their independent living situation. This year, the foundation will be participating with John Knox Village in the refurbishment of Majestic Oaks. This partnership will make it possible to provide upgrades to the furnishings and equipment that will be selected for patient rooms. The foundation has also provided grants to organizations that benefit our independent living community. Some of those organizations that received grants during the past year include the Village Notables, the Stained Glass Committee, the Library, and the Gardening Committee. All of these activities are made possible by donations that the foundation receives from residents and family members. And for this, we thank you all very, very much. The foundation board consists of 9 directors. 3 are JKV residents, 3 are members of the JKV Board of Directors, and 3 are community members. In addition, the foundation board also includes our secretary and assistant secretary. The foundation is also fortunate to have a dedicated group of volunteers who administer 3 fundraising projects. The Oak Tree Society provides financial support for the foundation. Members of this society pay an annual membership fee of $5 and display a gold oak leaf on their name tags. This program is administered by Lori Brakeman. Kim and Jeff Larry are in charge of the Foundation Walk Paver program. And for a $100 charitable contribution, an engraved brick paver containing a message that honors a loved one or commemorates a special occasion is placed in the circular walk surrounding the beautiful oak tree at Lake Fountain. And Betty Laux is responsible for maintaining the tribute book, where donations are recorded in remembrance of a friend or loved one. And now, John Brim, the foundation's treasurer, will present the financial report. John?
Thank you, Linda. As Linda has said, we're going to look at the financial statement for the JKV Foundation for 2022. These financials are currently being audited, as they are every year. We have a PowerPoint, and Candace is going to assist me on this, We needed to do a revision of it at the last minute this morning, but no problem. We'll take care of that. So at this time, Candace, let's put on the first slide, if you would, please. Okay, in this slide, you can see the assets of with the balance sheet compared to what they were the previous year. As you can see, we have most of our assets invested with Ameriprise Financial. 2022 was not a good year for the foundation investment portfolio, as it was for everyone else. This slide shows that we sustained an unrealized loss of $1.3 million in value, which was 14.7 decline in value. We did, however, outperform the S&P 500 index, which declined 19.44%. One comment, this decrease that you see in front of you is the decrease, obviously, in the value of the fund. There are other factors that go into that, such as contributions and income and distributions, which there were none. However, the unrealized loss was virtually the same thing as the decline here. And it is reflected in a slide that we'll be showing in just a couple of minutes. Most of our funds have liquid cash commingled into one Main Street bank account. This slide also gives you the allocation of the cash balances to each of the classes of funds. And that concludes this first slide. Candace, can we have slide 2, please? This slide discloses how the assets are to be used and who controls the use. The foundation is an organization of currently 15 various funds that define the use. The funds are first grouped into 2 groups, either with donor restrictions or funds without donor restrictions. Then the funds are further grouped into 3 subgroups, which are endowment type funds, then restricted use type funds, and finally a general fund to cover overhead type expenses. Please take a moment to review the current list of funds that you can see behind me and the balances in each fund. Hopefully you can see the figures. While you're doing that, I will mention that I put in the table over there about a limited supply of our financials, that what you're seeing on the slides here. If you're welcome to take one with you, I will look, and if there are none, if we've exhausted the supply, because I didn't know what to prepare for on that respect, you have my name and you have my email from the portal. Just please give me an email and tell me you would like to have these financials, and I'll be sure that you get it. Okay, Candace, let's move to slide number 3, please. Here is one that I'll have to be very careful because of our adjustments we made this morning. This slide shows this is 3A, I should have said, and I'm sure that's what it is, but there is a 3B also that will follow. This slide shows the income for the year by source and by fund. Linda mentioned these, she used a different term. I think this on the new grants, I think she used committees and things like that, and that's true, what she said, but the accounting for that is in terms of a fund, and that's what is displayed. The fund headings at the top of the correspond to the list of groups in the previous slide, except for the unrestricted fund, which is the village general fund in the prior slide. The major sources consisted first of the contribution and bequest from residents of $323,000. I'm not sure if Linda mentioned that or not, but that is on this first slide that you can see. The two largest restricted giving fund sources were the spiritual life and auxiliary funds, with close to $28,000 each in income. The medical auxiliary, as you probably know, is a beneficiary of the thrift shop sales. Let's move on to 3B, please, Candace. Really, the only thing on this slide I want to call to your attention is the investments, earnings, which were $206,000 in interest and dividends. That figure is virtually the same as it was the previous year, even though we had a large decline in value. However, our total earnings, if you will, went down by $100,000 due to capital gain distributions, and that is due to the market. But that is the one thing that I wanted to point out on this slide. So now, please, Candace, let's move on to slide number 4. This slide reports our expenses for the year. Please note that our expenses for residence assistance, as Linda mentioned, was $130,714. And the expense for other projects was $151,287,000, which included reimbursement to John Knox Village for the renovations made to the gift shop and to the new library. Our broker advisory fees expense was $26,400, which was down 32% from the previous year, 2021. That concludes that portion of my report. I'll allow some time if you have any questions in just a minute. I do have one other thing to report to you. Another matter to be reported for 2022. The foundation is and has been classified as a public charity with the IRS. During 2022, we have requested the IRS to reclassify the foundation as an organization that supports a public charity under Code Section 509A3. We have not yet received the IRS approval. This change will not change anything regarding the foundation's functions or activities, which has been and will continue to be activities that are in support of JKV of Central Florida, which is a public charity. It will still be a Code 501c3 entity, and all gifts are tax deductible as they have been. The reason for this change was that we were in danger of losing our status as a public charity and having the IRS reclassify the foundation as a private foundation. This would require us to pay a tax on our investment earnings. All nonprofit charitable organizations are presumed to be private foundations unless two things. Either they meet the IRS public support test or they are to be classified as a public charity that supports charity that supports a public charity, as what we're doing. And so that's kind of a mouthful. And so now I'm going to, before I've closed, I'm finished. Are there any questions or anything that you want me to expand on? All right, in the back over here. Go ahead.
I guess we don't have a microphone.
Oh, yeah. Just thank you. Just speak up, please.
Is it working? Yeah, it's working. My question relates to the biggest thing that happened in 22 was the unrealized loss due to the markdown of the market value of your investments, right?
Correct.
Can you tell us what has happened from January 1 of this year to,
Yes, I can.
present? What has happened? Has there been a gain, a loss, or what's happened?
I looked at that this morning, and currently, or as of the close yesterday, our value is up slightly from the end of last year. However, we lost, I made a note of this and failed to bring it with me, we lost about $47,000 yesterday. But answering your question, the value of our portfolio is just slightly above what it was at the end of 2022. We will be having a finance committee meeting, and we're going to have a discussion with our advisor on what, if any, changes we can make, given this very, very volatile market that we're in. And we will see what, if anything, we are more aligned now with the S&P 500 portfolio, which is why I mentioned that we did outperform them. But you know, I won't go into it. But we'll be having a finance committee meeting, and we will be discussing what corrective action is recommended, if any.
Thanks.
Mm-hmm. Was there another? I thought I saw two hands back there.
I have one more.
My eyes are not that good. Is there anybody else?
I have a question on concerning the commingling of the.
I'm sorry.
Okay, I have a question concerning the commingling, possibly, is it
Yes.
from the JKV Corporation as opposed to the
Yes.
foundation? Because now JKV is, from what I understand, also doing the accounting or tied into it in some way. Is it,
Yes,
so
sir.
is there any possibility of commingling? Is it separated completely from JKV Corporation?
Yes, sir. Thank you for the question. We are completely separated from the JKV Corporation. We have our own foundation bank account with Main Street. 2 years ago, I believe it's right, Linda, we agreed with the JKV accounting that they would do the bookkeeping, and they are. Not only do they do the bookkeeping, they handle the deposits and the writing of the checks. Before that, we did it ourselves on a volunteer basis. I thought you were going to ask about the commingling, and you did mention that. We're very careful to keep correct tracking of the money, and we balance it at the end of the year against the funds. That's that second slide that I asked you to look at that has those balances. We make sure that those balances are funded. And how are they funded? Either by our investments or by the portion of the Main Street bank account. So all that is reconciled. Actually, we've been doing that. The foundation's been only using one bank. Instead of having separate bank accounts for each fund, we feel that this is a better way, most prudent way to do it, and that's the way we have been doing it since the beginning of the foundation. And it does meet what you would call GAAP standards. There is no, the auditors are very okay with it once we show them how we are able to account for the money. So did that answer your question? I'm sorry, did I answer the question? Okay, anything else? Did I see a hand back here? Yes.
I just wanted to ask regarding the Ameriprise accounts, is that primarily mutual funds or is it stocks and bonds? What's the makeup of that?
Okay, our investments are in a 60-40 ratio. 60% is invested in equities, okay, and 40% is in fixed income. The equities, yes, are in mutual funds and in exchange-traded funds, which is a mutual fund. The makeup of the fixed income, the 40%, I'm not going to attempt to answer that. But I do. That's one. I say I'm not going to attempt to answer it. I can't answer it. I depend on our investment advisory. However, at our meeting, I intend to bring up the fact that in years past, as everyone knows, the banks have, you couldn't get any income from the banks. Now, as everyone is aware of, you can. And so it could very well be that we could take some of our fixed income allocation, 40% allocation, and put it in CDs or money markets. That would be one of the matters for discussion. By the way, our bank account, you saw that I had on the screen, it's just over $300,000. We just purchased a $50,000 CD for the Spiritual Life Fund, and That now brings us down to less than the $250,000 that we are insured by FDIC on our bank account. Does that answer your question?
Yes, thank you.
Anyone else, please? Okay, that's it, I guess. Thank you. Oh, I'm sorry.
I don't know if you're able to answer this question or if anyone could, but based on your experience, do you feel that the total assets are adequate for upcoming needs? In other words, should we be soliciting for more donations, or are we in good stead financially?
We are in good, steady position financially. We really, this is my opinion, which is what you asked for based on my experience. I think we have, was it 6.5 million or whatever the balance is we looked at is close. It varies. It was 7 million, now it's down to 6. We have ample assets to cover the needs of the residents. But I want to mention one thing, and that's our endowment fund. I didn't go into details about the funds, but the endowment fund is one that was been in existence since the beginning. And that fund, if you restrict your gift to the endowment fund, it is only to be used for residence assistance. Therefore, because of that, it meets a standard that is governed by Florida law. It's the Florida Uniform Prudent Management of Institutional Funds Act, and it tells us how we are to handle a true endowment fund. And basically what it says is that we can use them. We can't use the principal. Not only can we not use the principal, they have a different standard than just use the interest. Their standard is that we have to pair our spending policy, which is residence assistance, against the investing policy to ensure that the original contributions maintain the purchasing power of the investment, the original investment, which means that we have to cover inflation. And inflation in the past 30 years is significant. We are close. We are still okay. Well, we're okay as far as being underwater, but we're not okay with respect to meeting the standard of inflation. Okay. So therefore, we are not using that fund. Didn't use it last year. That 150,000 came out of our board designated endowment fund. Still plenty of money. It's just that we have to abide by the method to manage that fund that is governed by Florida statutes. So that fund, certainly, when I answered your question that we have plenty, that could be an exception because there is not enough money. Not only are we deficient, if you want to call it that, with respect to the inflation factor, but also even if we were covered with that inflation factor, we still don't have enough money in the endowment fund to pay for the residence assistance. So contributions, and I want to be very clear on this to everybody. If you write a check to the John Knox Village Foundation, it won't go into that fund. If you are intending for that money to go into the endowment fund, which is restricted for residence assistance, you must put in your bequest because that's usually where we get it, is we do get contributions, but mainly from bequests. You must put in that bequest that is for the, not just for the John Knox Village Foundation, but it's for the John Knox Village Endowment Fund. I have no doubt in my mind that a lot of the money that has been contributed was intended in the minds of the decedent that this money go into the endowment fund, but it wasn't restricted for that. There's no harm done. It's just it's something that I think needs to be communicated. I don't think it's been properly communicated, and I'm glad you raised the question because I needed to say that.
So I don't have to lose sleep if I go bankrupt?
I'm sorry?
I don't have to lose sleep if I go bankrupt?
No. We're in good shape. We're in very good shape. Anything else? And again, my eyes. I think that'll be our last question. Okay, that's it. Thank you.
Thank you very much, John. And I'd just like to add one thing on fundraising. Well, this year, as I mentioned, we're going to be taking on a larger than usual project, which is helping with the refurbishment of Majestic Oaks so that we can make our residence rooms nicer than they would be if we just use the bare, just the one source of sourcing of funding. And in the future, there is a possibility of a new chapel being built, and we would want to be partnering with that as well. And I'm pretty sure that if that does come to fruition, we probably will have a separate request for funds at that time, just as a little extra to your question.
Linda, may I ask a question? I'm sorry, I had to find this piece of paper before you stepped away from the podium. I appreciate you pointing out that when we make a donation, we want it to go to the foundation, that we need to signify that on our checks. What is the difference between that and the Oak Tree Society that sometimes we put on our checks?
The Oak Tree Society is a membership society that allows all residents to participate in a small way, the $5 membership, and to be a part of the foundation. That money goes into what is basically a general fund to be used for projects. Is that correct, John?
No, it goes into the endowment. It is part of the endowment.
I stand corrected.
It's dedicated.
Okay, that one does go into the endowment fund. Okay. Well, today we are also very fortunate to have Greg Lafice with us as our featured speaker. Greg is a native of Florida and a graduate of Stetson University. He is a CPA and a managing director of the accounting firm of Lafice and Company. Greg serves as a director for the John Knox Village Board of Directors. He also serves as a director for the foundation. Without further ado, I'd like to turn over the podium to Greg Lafice.
Good morning, everyone. It's an honor to be here, and it's an honor to have been selected to come talk to you. I've got a few comments that I'm going to make, and so we'll be going through this, and we should be done about 3 p.m. this afternoon. Just kidding. All right. As Linda said, my name is Greg Lafice. I'm an unusual CPA in that I do lots of things, wear lots of different hats. Literally, I wear a Stetson hat. My family owns and operates. We've been in the cattle business here in Volusia County probably since the 30s. We actually got the start, my grandfather got the start in the cattle business when he was in the fever, tick, and screwworm eradication program for the state of Florida. And so he had to dip cattle, and as a part of that, a lot of the cattlemen would pay him not with cash, but would pay him with cows. So, and from that, he was able to acquire property and acquire cattle, and so that's how we basically got our start. We have offices in 4 different places. We have one here in Orange City, we have one in Ormond Beach, Titusville, and one in DeLand. So basically, like Linda said, I'm a Volusia County native. My great-grandfather came to Central Florida in the early 1800s. My ancestors came into Savannah, Georgia in December of 1792. In May of 1793, my ancestor got a medallion for being the best shot of the day, and it's in this Georgia Museum up in Savannah. Now, what he shot, I have no idea. So anyway, so that's what we have. That's probably the best way I knew how to take a look at what taxes really are all about. Think about flossing your teeth. It's something necessary, but it's not necessarily pleasant. So when you're dealing with taxes, it's something that you have to do. So let's do some exercise. Raise your hand if you pay income tax. All right. Keep your hands up for those people that like paying income tax. All right. So knowledge is power. And being aware of what's going on in your tax sphere is very, very important. I said I was an unusual CPA. One of the avocations that I had in my life, for 42 years I officiated football. I was a football referee. I finished up my career, the last 22 years of my career, as a college football official, and I worked in the SEC and also the Sun Belt Conference. And so I've got tons of stories, and when you were dealing with knowledge and being knowledge being power, I recall a play we had, and it was in a playoff game in my high school days. We had a pregame, and our crew got together, and we always like to inspect the football field to see what hindrances we might have. Are there bleachers close to the playing surface? Is there proper police presence? And in this particular stadium, between the light standards, there was a cable that ran between the light poles upstairs. And we talked about what would happen if football hit that. So we went and we did some research, and here it was, about 32 seconds left on the clock. The team that was ahead by 2 points, 4th down, they had to punt. So they punted the ball. The ball flew up in the air, and it hit that guy wire. And it fell down to the middle of the field, and the punting team recovered it. So they erupted in joy, and they thought they were going to be able to run the clock out. It was their ball. They recovered the ball. So I killed the clock, turned on the mic, and said, based on the fact that the football touched something in the field of play, it's classified as an inadvertent whistle. We will replay the down. So that coach that just punted the ball wasn't real happy. So he comes running down the field, and I met him about the hash mark, and he says, you are, I can't say. So anyway, he said, talk to me about this. I said, well, Coach, according to Rule 432BA, it states that anytime a live football touches anything in the field of play other than a player, the ground, or an official, it shall be declared dead, and it shall be treated as an inadvertent whistle, and the play will be replayed. And he walked away. He didn't have anything to say to me. So knowledge is power, so we're here to talk a little bit about that. Who in the room has ever gotten a speeding ticket? Oh, come on now. I have. So a fine is a tax for doing something wrong. A tax is a fine for doing something right. So, but I always tell my clients, I would much rather you make a $500,000 and pay $100,000 in taxes than say the heck with it and give up and not make but $50,000, because you walk away with an extra $400,000 in your pocket after paying your income tax. So don't ever be afraid of that. So let's talk about income streams, stream of expenses. We're going to talk about what's going on in the legislature right now, and then we'll finish her up. Basically, we're sitting here in a group of very accomplished people. And in this room are airline pilots and retired CPAs and administrators and police officers and firefighters and entrepreneurs and small business owners. You guys have already done that, and you've done very well at it, and you're to be commended for that. Your retirement stream is set. And you know, as a CPA, as I become more experienced in life, and my client base becomes more experienced in life, I find myself advising my clients on what to do. Setting aside the money thing, because the money thing we've advised them all along, but I find myself talking about what are you going to do Monday morning after you retire on Friday afternoon. So we talk a lot about the psychological side of that. So we do a lot of things when we're dealing with our clients. And so when we're talking about revenue and income coming in, that's pretty well set. You guys have done a good job. And so it comes in a variety of different ways and different investments that you may have. And see, here's the thing about the Internal Revenue Service. The federal government is a very clandestine organization. They snoop on everybody. And every 1099 that you have is a means of which the federal government keeps track of what you're doing. If you'll notice, you probably haven't heard of anybody in the last 15 or 20 years ever being audited by the IRS and them coming to your house, sitting at your kitchen table, going through receipts. They just don't do that anymore. The way they do that, there's only about 1.1% of the total tax returns filed is ever audited by the IRS. But the reality is 98% of your tax returns are audited every year. They're audited electronically. Because all of these things that I have in front of you on the screen, all your interest, your dividends, your capital gains, your distributions from your IRAs, your pensions, your Social Security, they're all supported by a piece of paper that the Internal Revenue Service receives. So before you even file your tax return, they already know how much money you've made. So if your tax return doesn't properly report what's on the 1099, you get one of those friendly nastygrams from the Internal Revenue Service. So they pretty much already know exactly what's going on. So let's talk about what do we do to reduce our tax bill. That's probably the most asked question of me out of everything. The second most asked question is, oh my gosh, Greg, you're telling me I made $320,000? No way. No way. So let's deal with the first one first. How do you reduce your tax bill? Now, I'm sitting here in front of very accomplished people. Your income is set. Interest, dividends, capital gains, Social Security, blah, blah, blah. And so let's talk about that income's not going to change. I want you to make more money. I want your dividends paying capacity to become more enhanced. And hopefully the market will recover and you'll have higher and better, stronger capital gain reporting. So the only thing we have some flexibility, possibly, is some of the expenses that you may have. Now, what happened in 2018 when Donald Trump took office, they changed some of the tax laws, and one of them he doubled your standard deduction. And what he did was, said, what is the average itemized deductions that most Americans have? And they basically said this amount. So basically what he said is, I want to streamline the federal government as much as I can. So what he did was he eliminated certain departments within the Internal Revenue Service. And he did that, he accomplished that by saying, we're going to make your standard deduction high enough to where you will take the standard and not have to worry about itemizing. So if you don't itemize, then that means that's one less thing that the IRS has to look at, because the itemized deductions, the IRS doesn't have an idea of what those are. There are no reporting, basically. They do for mortgage interest. So basically, he made it high enough to where everybody will basically take the standard deduction. Now, here at John Knox, as you well know, you have an entrance fee and a percentage of every monthly service fee that you pay. A portion of that is deductible for medical. So the very first you come in, you might have a pretty good size deduction for medical because of your entrance fee. And the medical portion of it, it ranges between 24 and 25, 26%. It changes every year based on what the accounting department determines. So basically, in those years, you're probably going to be able to itemize. If you have heavy charitable contributions, and we'll talk about some strategies on charitable contributions in just a second, but nationwide, only 13.7% of the total tax returns see an itemized deduction. So most everybody takes a standard. So basically, when you're looking at that increased standard deduction, that is what caused a lot of Americans really a larger benefit, because for someone that is in your situation, if you're married, your standard deduction is $30,000. Some people, a lot of people, may not have $30,000 worth of itemized deductions. So now, as a resident of John Knox, you have medical, you don't have any real estate taxes, you don't have any mortgage, you do have charitable contributions, and you don't have miscellaneous stuff. So the only thing really left is medical and charitable contributions. So most people probably don't have $30,000 worth of that. So medical, first of all, has to exceed 7.5% of your adjusted gross. So that knocks off the first 7.5% of what you paid before any of it's deductible, which is the reason why most people take the standard. Charitable contributions. That's another area that you can utilize to help reduce your total income tax. And let's talk about a few of those. Obviously, we've heard this morning that both the foundation is a 501c 509(3) organization, supporting organization, and your contributions are tax deductible. So how do you do that? Well, you can write a check. That's simple. You can, a lot of you are required to take minimum distributions from your IRAs. There is a strategy out there, it's called a qualified charitable distribution. And so you can make contributions directly out of your IRAs and have your financial advisor direct that person to send part of your required minimum distributions directly to a charity, and that qualifies as part of your annual required minimum distribution. So instead of writing a personal check, you have your financial advisor write the check for you. So you get the standard deduction already of $30,700 for 2023, and you get a reduction in your taxable income because those checks go directly to the charities. So that's something you may want to talk to your financial advisor about. There's also an estate planning strategy that we sometimes utilize. It's called a donor advised fund. And what those do is it gives you an opportunity to take, let's say you bought Tesla stock when it first came out. Can I be your son? And so basically, it's appreciated crazily. So you have a very, very low basis. So if you put those particular stock into a donor advised fund, then that is now out of your estate, and you don't have to worry about paying income tax on it if that's what you choose to do as far as making that size of a contribution. But there are other strategies as well. Estate and gift tax. We're going to talk a little bit more about that in just a second. But estate and gift tax, right now there is a unified credit of about $13 million per person that you can utilize for gifting. So right now you're never going to pay gift tax. But we'll be talking about that in just a second. And there is a concept of portability. And the portability for that $12,920,000 is portable between spouses. So I've got 12,920,000. My wife has 12, and so between the two, so you can see there's about $26 million that I'm able to shelter before I owe anything for estate taxes. So that's something that's good. Now let's talk about what's happening. Okay, one good thing, as a CPA, as trying to hand out great, current, applicable tax advice, really exciting stuff, Congress is just fighting over everything. They don't get along. They can't get anything done. Everything's down party line. And so in my world, that's a good thing. Why? Because they're not changing any laws. And so thank you, Jesus. And maybe one of these days they'll learn how to get along and just listen to each other and look at us, because that's who they represent. So it's interesting. So let's talk about, the president put out a budget a couple weeks ago. And there's been a trend in the last 10 years that presidents put out budgets, which kind of gives their vision of where they'd like to see the country go. Well, it's not up to the president. It's not his budget. The folks that control the budget, the folks that control the purse strings, is the House of Representatives. It's their budget. Now, the president, have some input, of course, but here's what President Biden currently wants, and this is what is in his latest budget proposal. He wants to increase from 37 to 39 on the top rates, and you hit the top rates somewhere around 540,000. So once you hit 540, then you're in the top rate. Rates below that are 10%, 12%, 24%, 28%, blah, blah, blah. So your typical person, typical tax return of everybody in here, you're probably in that upper echelon of those tax rates. It very well possibly could affect you guys in the future. Long-term capital gains, the operative word there are the last two words, 1 million. They want to tax long-term capital gains. They want to tax qualified dividends as ordinary income, because capital gains is at a 20% and you got 39.6. So there's, basically about a 16-point difference if this plan goes through. But that's only going to affect the people that make more than $1 million. And this is where it gets scary. Impose a minimum tax on wealthy taxpayers. First of all, what is a minimum tax? And secondly, what's a wealthy taxpayer? It's lacking any type of specificity. Is a wealthy person more than makes $250,000? Is a minimum tax 30%? The devil is in the details. Net investment income tax, right now it's 3.8%. 3.8% goes towards paying for Obamacare. And that's for folks that make above $250,000 as well. They want to take that same net investment tax and apply it against pass-through entities, partnerships, S corporations, those kinds of things. Carried interest, that's an obscure methodology by, it's used in determining compensation for hedge fund managers and that kind of stuff. It's not going to affect too many people. Shifting to related parties between partnerships, shifting their basis to try and avoid payment of income tax. Limitation, that's another very obscure thing. And here's the last one. Modify estate and gift tax rules. That's really scary. That's really, really, really scary, because that is extremely broad reaching. It affects everyone. If they drop, and everyone in this room will remember, the unified credit used to be $650,000. And $650,000 today, it would affect every single one of you in this room. And the tax rates for estate tax is 40%. So right now it's $26 million for a couple and $13 million for just a single person. And once you get above that, then they take 40% of everything that you've got. So basically it is, if they change it, if they do away with it, or if they bring it from 12 million down to 1 million, then all of a sudden, a lot of people in this room is going to have to pay a state tax and pay a lot of it. So I'm always very concerned about that, because it not only affects half to two-thirds of the folks in this room, but you go outside this room, every single farmer, every single rancher, every single small business owner, their roofing company, their construction company, their dental practice, all of those things potentially could be exposed. So it's important to keep tabs of that. When you're looking at the impact of some of this, you take a typical person that, if you were to convert capital gains rate to ordinary rates, it could potentially, you take somebody that has a $150,000 long-term capital gain. They sold a piece of property, and they've got $38,000 in dividends that were qualified. Going from capital gain rates to ordinary rates, their tax bill just went up $27,000. And so, that is of concern. And a lot of times they'll talk about, well, we didn't raise, right now especially, they didn't raise taxes. So just a real quick story. Inherited IRAs. My wife inherited an IRA from her dad in 2012. And in 2012, the law stated that she could take the value of that inherited IRA, and she's required to take minimum distributions because her dad was taking required minimum distributions, but she could spread that out over her lifetime. And at the time, she was 52. So her life expectancy is probably 80 or 82 or whatever, so it's probably 30 plus years. So a couple years later, they said, well, how about if we make it an inherited IRA, you have to receive it, take it out over 10 years. And then a couple years later, they said, well, how about if we take that out over 5 years? So now you take a $200,000, say a $200,000 IRA over 30 years, do the math, and then you take it out over 10 years, that's $20,000 a year. You take it out over 5 years, that's $40,000 a year. Tax rates didn't change. They could tell their constituents that we didn't raise income taxes, but we forced you to have more taxable income. So when it comes to, and I could go on, there's probably half a dozen other ones. Social Security is a perfect example. Back in 32 or whenever, when Social Security Act came into effect, it's a trust fund. We'll set it aside in a trust fund. There's no trust fund. The money comes in the front door and right out the back, and they have a bunch of IOUs. And they said, we're never going to tax you on Social Security. That'd be ludicrous. Well, in 1986, it became taxable. We're only going to tax you at 50%. That's all we're going to do, just 50%. And now it's 85%. And part of this snooping that they do, every one of you that has an IRA, the IRA, your investment advisor is required to send in a Form 5498. And that is the quintessential federal government snooping, because it reports to the federal government what your balance is in your IRA. They're asking how much money you got in your checking account. Now, why do they need that? It doesn't go on your tax return anywhere. It doesn't cause you to pay any income tax. It's the federal government wanting to find out how much money is really out there in retirement accounts. Well, why do they need to know that? Well, let's see. There is estimated $116 trillion out there in retirement accounts. If we taxed everybody just 1%, and then that 1% becomes 2, and that 2% becomes 5, and next thing you know, we don't have much left of our, and we have an economy that the market tanks, and next thing you know, it's been altered financially pretty drastically. Same thing with back in the day when you were receiving a W-2, working for a big company, they're required, still today, to report how much was paid in for your health insurance. And again, that doesn't go anywhere on your tax return. It's not a deduction. It's just another way that the federal government is data mining and finding out when IBM, when General Motors, when Apple, when Tesla, when Ford Motor, when they pay for their insurance for their employees, how much are they paying per employee? Now, why would they need to know that information? One day, they might want to do a single-payer federal government-provided plan. Don't know. So when it comes to overall income tax and what to do and how to do it, stay involved. You do your reading. Ask around. Ask your financial advisors. The charitable contributions is something you need to talk to your financial advisors about. And so when you file just in the closing, because I use this comedy, this little statement every once in a while, you file a Form 1040. And a lot of people have asked me, why do they ever use a 1040? What's 1040? Is it a code section or whatever? What's 1040? I said, no, it's real simple. For every $50 you make, you keep 10 and they keep 40. So it's been a pleasure talking to you folks. Do you have any questions for me? All right, that's me. If you ever need to ask any questions, they have my contact information. So thank you so much for allowing me.
Thank you so much, Greg, for that very interesting and informative presentation. And thank you all for being here. If you haven't already picked up a copy of our brochure, I'd like to remind you that copies are available on the tables at both exits. We'll look forward to welcoming you to our next annual meeting, and in the meantime, we wish you a happy and healthy 2023. Thank you very much.